to fit that market. In particular, we offer a battery swap system. So we have battery swaps across a network of charging stations distributed around the city of Kigali, and that's what we're planning on expanding. We also have a motorcycle that we offer as well that has more power than a petrol bike and is cheaper to operate and to acquire.
Gotcha. No, thanks for the summary. So we have two energy-related companies, one from East Africa and one from West Africa. So love to hear your stories about how you've closed the last funding round. Can you tell us a little more detail about your last funding round and a little bit about the journey in getting to close? Who'd like to start? Ugwem?
Sure, I'll get started. So we just recently closed raising an additional 3.1 million towards a second seed round that was anchored by Total Carbon Neutrality Ventures. That's the venture arm of Total. You might know them as the energy/oil and gas company, as well as SoftBank being one of their first major plays on the continent in this sector. We are also joined by investors that span the energy tech space, like Powerhouse out of Oakland, to local investors like Lofty Inc., amongst others. Really, the objective of this round is we had built out our entire platform, so that's industrial grade hardware, IoT hardware, as well as software. And we had about 2,000 to 3,000 kilowatts of energy assets being managed by SHYFT technology. And at this point, we really needed the additional capital to essentially increase our operational capacity. The growth that's happening in distributed energy resources across the entire continent, but certainly we're seeing it in West Africa as well, has been tremendous over the past couple of years, which has meant that this round was really necessary to make sure that we can deliver and keep up with the growth that's happening in our customers' portfolios. So that means doing quite a bit of hiring. So if we have people that are looking for fun work in energy tech, emerging markets, you can find some opportunities on our website. But it's also meant market expansion. So most of our customers today are in Nigeria, but they're growing and we're starting to serve people outside of the market as well.
And your website is SHYFT Power, and that's SHYFT, right? SHYFTpower.com?
Yes.
Got it. Great. Well, thanks for that intro. Josh, let's hear a little bit about your business and this funding round that you just closed.
Thanks, Jim. Yeah, it's been a really interesting journey. I can say for sure. It's not been easy with the year of COVID as well. I think part of our challenge in fundraising has been that we're kind of a new sector. E-mobility is still very new as something at all. I mean, I think when we started off in 2016, I was sort of probably known as that weird guy who's trying to do electric motorbikes in Africa. Now we've seen more companies and sort of pop up in the e-mobility space. We've got Asobo with electric boats in boat motors on Lake Victoria. We've got Ox Delivers here in Rwanda with electric trucks. We've got several electric motorbike startups across the region. Max in Nigeria is adding some electric motorbikes to their business as well. So it's definitely been maturing, but I think we've found really a challenge has been, particularly here in the more regional East Africa market of venture capital funds, that I think they generally expect companies to be at a further stage with revenue. So that most of them want to see kind of $100,000 of revenue per month, off the back of the typical 500K seed round plus grants. And that's all well and good for an app or for maybe a solar lamp or something like that. But for an electric vehicle, there's just a bit more complexity, a bit more R&D, a bit more capital tied up to start really hitting volumes and sales. I don't think Tesla kind of reached $100,000 a month in revenue from car sales on the back of a 500K seed round, and and some and a couple of grants.
Right.
You know,
Much higher upfront cost, right?
Yeah, and so you know, there's just a bigger inventive step that's needed to get there. Now, we would certainly argue that the returns are well worth the effort, but it just takes a little bit more of a deeper dip into the pockets to sort of hit those revenue numbers. Another real challenge that we found is that just that on a Series A, a lot of the VC funds out in the region do really want to use a DCF to do valuation, or will even come in with project finance valuation methodologies, which, you know, when we go to Silicon Valley and fundraise, people just laugh at. You know, I think a lot of the investors in the region do come from a more of a private equity background or investment banking background, and the whole Silicon Valley thing is a little bit of a cultural shift. And so in the end, we did raise from Silicon Valley. Firstly, last year we had a term sheet in front of us. I'm not going to name names, but we had a term sheet in front of us at the end of March, and then within the first week or so of April, as we were working on the draft, the investor pulled it back because COVID numbers were surging in California, and that's been a tough, precipitated, or was the start of a tough year. But we're grateful to our grant funders at Shell Foundation and USAID, who really helped us through there. And then then we were very glad to be approached by Ecosystem Integrity Fund around Christmas time, and you know, they move quickly and professionally. And here we are at the end of April with a few weeks now ago that we signed our Series A, so for $3.5 million US, which is massively catalytic for us.
No, congratulations on that. And so I know that both of your guys' businesses is very capital heavy, capex heavy in particular. On your side, Josh, obviously you're building things, and as you mentioned, it's not the same as building an app. And then on your side, Ugwem, it's really much about deploying hardware at enterprise, which is also quite capital intensive. So did you find that the type of investors that were available to you in your markets, in East Africa and West Africa, you had to look in some not odd places, but outside of the usual suspects in order to capture financing for CapEx?
Absolutely. I think I echo a lot of the sentiments that were just shared. With the challenge with us in finding investors early stage and addressing the CapEx for us, because we had high voltage industrial grade hardware, it meant that the amount of testing, prototyping, I mean, all that stuff you have to do early stage just to even get a pilot is far more capital intensive than iterating on a mobile app. And so when we were looking for investors, our earliest investors were actually corporate strategics, or folks really in deep tech, or that had a lot of experience investing in hardware or manufacturing type innovation, because they could really understand what it takes to get to certain stages in revenue and whatnot. So that unfortunately meant that a lot of them were actually, our earliest stage investors weren't local, or they were open to global markets, but they're really coming from Silicon Valley, from Europe, from Japan. And that allowed us to kind of get to the point that we were for this round, where we could actually have deployments, early revenue coming in, and kind of de-risk the concerns or the discomfort that some investors have with capital intensive type ventures.
Yeah, I mean, I noticed that both companies raised most of their round, if not all. I don't know what percentage are coming from local investors, but most of that is coming from international investors, so with participation from Silicon Valley on your side, Josh, and on your side from a pretty broad range of French, Japanese, and otherwise. How do you get them comfortable with the local market conditions and help them understand both the opportunity and the risks appropriately?
Yeah, I guess, Josh, feel free to jump in. Well, for us, it was some of like our corporate strategics, they're familiar or they're deploying products like ours in the market. And then secondly, for our business, we really set it up to mimic the operations and structure of existing companies that are reputable and scaling in the market. So looking at companies like Schneider Electric and other energy tech companies that are deploying assets in the market, and how they essentially structure and organize their business, so that when they might have concerns about just doing business in these markets, operations, logistics, how we're structured, governance, that it looks similar to models that have been successful in the market. So that was kind of key. But again, early stage strategics, there was something about them that allowed them to understand market dynamics. So either they were doing infrastructure projects in other emerging markets across South Asia, Central and Latin America. So I always stress to founders that are raising that, there's a certain level of convincing you should do with your investors, but if it's too much, and they just might not be your right investor. If they're totally uncomfortable with the market, then that just might not be a good fit, even if it seems like they're excited about your product. So it does mean that it might be a bit more challenging to find, to kind of gather that pool of investors that are a good fit.
Yeah,
go ahead, Josh, please.
I was going to say, yeah, we certainly found obviously getting comfortable with the market on the ground. Our investors are eager to have co-investors who are familiar with the local context and who are a bit closer on the ground. And we do have Factory Ventures, our seed investor, still very much involved. And with a presence in the region, lots of experience in the region. So that's a big help, having co-investors to, particularly ideally participating in the round, to give that degree of confidence. I think also just to related to the earlier question, we being a hardware business does limit the number of VC investors who are interested. There are plenty of investors who just don't do anything related to hardware. So there's a narrow
CapEx heavy.
Yeah, exactly. Anything CapEx heavy. And I think we have been we have pleasantly discovered in the course of building this business model the relative modesty of the capital intensity of our model, is because we're dealing with this B2B market where the assets are sweat very heavily, but still there's still money that is being spent on buying physical objects, and there's supply chain complexity and uncertainty that a software firm doesn't really have to worry about. So it's definitely narrowed the number of investors. I think also what seems to have made us stand out in ecosystem integrity funds, EIF's view was that we were really targeting a mass market segment, and we were really focused on putting something on the road that's in the context of climate change and the overall clean energy transition, something that was cost competitive with fuel in a really mass market segment. I mean, there were probably 500 e-motorcycle electric two-wheeler startups out there on the road, but almost all are really focused on a much more niche, starting with the motorcycle equivalent of the Tesla Roadster, right? Like the top spiky end of the Hershey's Kiss business model, and then with the idea that they'll work on down, and very few make that transition into a much more mass market, accessible, affordable vehicle, and out of the garages of big mansions in Menlo Park, I guess.
Yeah, so that's interesting, and I find it interesting that the pandemic, you did this during the pandemic, and while it's perhaps assumed that things were a lot harder during the pandemic for fundraising purposes, and I know, Josh, you guys were impacted by that from your first funder. But more openly, I'd like to ask the question: has the lockdowns and the pandemic helped or hurt your fundraising efforts? because I've seen in some ways that the fact that people are more digital and more able to converse across borders via Zoom and otherwise, that has actually helped communication in some instances. How has that affected you? And this is a question for both of you.
Yeah, for me, it really meant I was able to engage, far more investors than I think I might have been able to otherwise. It wasn't traveling, to get coffee or spend weeks in one region or the other. And there was just a lot more virtual type of events, virtual communication. So intros are happening and, points of contact are happening at a greater frequency than I think perhaps might have happened otherwise. Yeah, so that was definitely apparent, but I do think there was a downside, and it depends on the type of founder. But for me personally, I really like to connect with people in person. It's easier to kind of just not like jump straight into like, okay, here's a meeting, here's a deck, let's go. There's a level of being able to walk into the office, show what's going on, or grab a coffee that I think made things more personable. And and as an early stage founder, a lot of fundraising and decision making is happening, but based on how much investors believe in you as a founder. And so you had to kind of figure out how to kind of convey who you are and just those less tangible things that sit outside of a deck, still figure out how to be effective with that virtually or via Zoom. And I did find that to be a bit different and challenging.
Okay, yeah, that's interesting. Yeah, I definitely can see the two sides, especially the side where connections and introductions and can be faster and greater in number, but ultimately getting to know your investor or investor getting to know entrepreneur, which is an important aspect of early stage investing, that's harder to establish that rapport and mutual understanding. I can definitely see that.
Yeah, I think we've also had a mixed bag. I think there's definitely been a lot more events and interactions like this one today that are possible. And Kigali's a really long way from the centers of finance in out there in the rest of the world. We just don't have those natural. We just don't bump into VC investors at the local bar,
right?
In the same way. We were fortunate enough that that during diligence, someone from EIF actually came out. We had a window before Nairobi went into its recent lockdown.
And EIF is the fund that ended up doing the Series A.
Thanks. Yes, the Ecosystem Integrity Fund, and came out, and it really hit home just how much you can get done, how much further you can get with that person to person. I think particularly around we also went across. So we were here in Rwanda and also went across to Kenya where we're expanding to, and we're able to bring EIF along on meetings with customers like out there on the street, and in a bunch of different meetings with potential partners that we might get with, might link up with. And I think for the investor, it's really great to see see the interest from the customers and the reaction from our existing customers. We got to go to visit the home of one of our drivers who can really in their own words explain and show what the value proposition is, and that they believe in what we're offering, and the difference it makes for them, as well as just the excitement and validation from meeting with some pretty serious potential partners who really know the industry and are excited to be working with us. It's really hard to get all that from Zoom calls, and
of course.
We did some virtual. We did innovate a little bit. We so the usual kind of visit of the business and interviews and introductions to staff, just showing our production line. We did sort of virtual video tours, and sort of and being a bit innovative with Wi-Fi dongles and awkward camera angles, but managed to get there with a bit of a sense of humor.
And how well I'm very curious how well the virtual tours, for example, worked. How successful were they?
Pretty well. Production values were not exactly CNN, I would say. But we organized it, had a run through kind of with different members of the team who were, say, responsible. So we had Nataya Harimoto was responsible for a lot of the battery assembly, showing off part of the vehicle, part of that, and then we had my colleague Alp showing part of the battery assembly, and then part of the vehicles, and so there's a chance also just to get a feel for the team members and how they're able to explain what they've done and why we've done it, and the processes that we've gone through, and improvements in the different generations of the technology that we've gone through the process. I would definitely recommend it as an option to people, and it also means that you can show things that you wouldn't normally show.
Right.
You wouldn't normally show. Doing it live also means you have some more protection, I think, around IP. It's not sort of something that should really be forwarded around and put on the internet. So you can show really the more sensitive parts of your process.
Yeah, got it. So no, very interesting. Thanks for those stories. I do want to open up a bit for comments and questions from the audience. So please feel free, if you'd like to ask a question or make a comment or even share your story, please raise your hand and we'll bring you on stage. We do have Bastian on the stage as well, Bastian Müller, and love to invite him and introduce yourself. And if you have a question or a comment or a story to relate, please jump right in.
Sure. Yeah, first of all, thanks for inviting me on stage. I actually wasn't planning on joining this room. I kind of stumbled into it.
Well, you stumbled in the right place.
Yeah, and I'm from the Siemens Foundation. So we're actually active in the e-mobility space. So Josh, I know you from the distance, what you guys are doing, and I'm coming from the investor side before I also joined. I worked in a social venture fund, and I have a remark and a question, and because I joined late, really sorry that already was asked. So maybe a quick comment on the virtual due diligence. What I've seen, what our co-investors are doing, and what we are also doing, both from my previous firm and now, it really depends on the maturity of the business, and given that the kind of space that we were active in, this early stage space, you really have to visit the company and be on the ground, because you're very much investing in the team and the company and the leadership team. And for that, you just have to meet them in person and see the facilities and see how the operation side and the production side is set up, talk to the customers. And that's unfortunately necessary. If it's a more later stage company and there are a bunch of investors already in there that you're very, very comfortable with, then we're also comfortable just tagging along, because we trust the people that have done the initial due diligence. And for example, actually just yesterday, we signed a few disbursements, but this was all for companies we already knew. So we felt comfortable doing that, even though they are affected by COVID, and we're taking that into consideration. But I think we wouldn't be comfortable investing into a company without actually visiting them on the ground. And that's unfortunately the downside if you sit in Europe. And that's also the reason why I actually want to have people in East Africa. If we don't know the company and we also don't know the co-investors, I think that would be a hard one. And then to my question, and that goes to Josh. And first of all, congratulations on the great work that you're doing. You guys are definitely amongst the pioneers in this space, and you described it. It was a tough fundraising process, but I have a feeling it will be getting easier in future. I mean, the topic is getting a lot of attention now, and a lot of money will be flowing into the sector.
Can we get you to commit to that, Bastian?
I can't make a verbal commitment, and we're probably not the ticket sizes that you're looking for. I think you have outgrown us. Yeah, you know the typical suspects. There are no kind of jumping into that. So I think there will be a lot. I'm sure there will be a lot more money in this space. But my question actually is, and that goes to your kind of business model, but also in general to like asset-heavy business models that we financed before or that I've seen in Africa. Is like once they grow, the working capital requirement really shoots up, of course, and like there's a large need to kind of pre-finance the assets. And my question is, because I have not seen someone really solving that, what's kind of the long-term solution for this? Because ultimately these companies, without knowing, end up to be kind of a mini bank or like a large MFI, which is a completely different business model, and you carry a lot of risk on your balance sheet. Which, yeah, can be really risky if basically if suddenly the cost of capital changes, which can happen, or like maybe a credit line doesn't get renewed. So I would just be curious about your thinking on that problem, or if you actually see it as a problem at all. Thanks so much.
Yeah, sure. Fair question, and one that we certainly get asked a lot. And I think we've been very happy to discover, well, we've been pleasantly surprised over the past couple of years to discover that the overall capital need relative to the market size and the revenue is fairly modest. We've projected a capital need of sort of $75 to $100 million to electrify all motorbikes in Rwanda by 2025. That's with new sales of motorcycles, not retrofits. And that's partly driven by the low cost of the physical infrastructure needed for the charging stations. We can build a basic swap station for about $5,000. We can build larger, more economical ones that start at around $13,000. So, you know, we could cover the whole city of Nairobi with about 40 stations for, you know, less than the cost of a conventional petrol station. The batteries do remain on our books, and that's a big asset. But what we have also happily discovered, some, you know, I don't want to take full credit for it, somewhat by accident, is that the rapid utilization rate. So we focus very much on the B2B market segment. We're not really in the business of supplying private customers, and you know that's 98% of all motorbikes on the road in East Africa are commercial motorbikes, right? So in Rwanda, they're doing about 150 kilometers a day. In Kenya, it seems to be around the 115 kilometers a day mark. And so the batteries themselves are cycling so rapidly that they're paying off their original capex very quickly. And so to put in context, the sort of $75 to $100 million mark in Rwanda, that's about 115,000 motorcycles, and that's about a third, maybe even a quarter of what is spent annually on fuel purchases by motorbike taxis in this market. So if your capex to electrify the whole fleet is only a third of just 1 year's revenue just on the fuel sales, which is the largest slice, but there's also motorcycle sales and asset financing and servicing and spare parts, also lucrative areas to make money. You know, that's pretty achievable. And you know, that's to put that in context, that's over half of the national vehicle fleet of the country being electrified, country of 12, 13 million people in the middle of Africa. You know, in the context of climate change and the targets we meet, you know, there's understandably we are getting a lot of interest from organizations like the World Bank. You know, that's a very achievable, something you can take to COP26 and wave in front of Western governments with a pretty modest price tag, and you know, there's a clear path there to get things done. For East Africa, there's 5 million motorbike taxis, larger market for sure. We're sort of looking at 2030 as the target. That's about $8 billion a year revenue in fuel sales. We project a capital need, debt and equity of around $2 to $3 billion. Just because the kilometers driven per day are a little bit less in Kenya and so on. I think we originally projected around 1.4 billion. I think that's creeping up a bit, but it's still a fraction of annual fuel sales.
Yeah. Okay. Cool. One quick follow-up question. So if I'm understanding you correctly, you're basically betting on financing this through international development finance. organizations, DFIs, and also the terms that they're offering that would work with your business model?
I'm hoping to see a blend. I'm hoping the private sector will come into the game. We're also in discussions with local banks. Usually the issue with them is collateralization. Particularly typically African banks want land and buildings as collateral, but they are by now experienced with working with guarantee funds, and there are a few institutions that offer such loan guarantees for such things. So that's a way to get pretty good value for money for DFIs as well. So we think that will play a role. But I think it's still early days, and I think there's going to be a process of evolution. There's a lot to be learned from, say, the solar home system sector in Africa, which is also an asset-based business. We would argue the unit economics are far better for a motorcycle with $240 a month revenue instead of $7 a month per customer revenue, and a cash-generating asset that's urban and not in a rural area. But there are parallels in the types of securitization of say loan agreements that can be done, and other ways to monetize the asset, the sort of collateralized asset of the motorcycle itself.
Just jumping in there, so just as a bit of a plug for Untapped Global, Bastian, that's actually what we do. So
good point.
We really focused on asset financing of CapEx-heavy businesses, such as
I just looked at you guys.
SHYFT
I just followed
and
you.
Josh. And the idea is exactly what you're saying, right? There's this gap there between companies raising equity and companies getting to a stage where they can borrow money from commercial banks and otherwise. And we think that there is a incredible opportunity to finance fast-growing companies like Josh's and provide the CapEx financing in a way that is safe and secure and providing really good returns for investors. And a lot of that is built around a different way of lending. A DFI or a commercial bank will look at things in a very conventional way. What's your balance sheet? What's your collateral? How do we de-risk it through legal means and through the collateral that you have on your balance sheet? The way we do it is to really look at the revenue streams generated by digital assets, because things are digitizing so quickly in Africa. We're able to capture revenue streams. And so I think, echoing what Josh was saying earlier, I think there's some great opportunities around the corner. Some of that has already been pioneered in different sectors such as consumer solar and so on, but really applied in a different way that can make for secure investing and good returns while helping companies like Josh's scale up very quickly.
Yeah, cool. Yeah, and actually somebody mentioned, I should go into you guys. One quick thing, because then I have to jump off on another call. I would be happy to stay in touch with all of you. I guess for the current offers that we're having, we're looking into early stage companies in the e-mobility sector, and they're actually very happy to support. So feel free to reach out. And then, let's say, for the more later stage companies, as the ones that are on this panel, there we might be able to engage end of this year without promising something, because as you know, the corporate foundation things always take longer than you expect. But it's kind of on my plan at least. Would love to also have a conversation with you guys from Untapped, because a lot of the thinking that I'm also putting into the kind of financing gaps is really the kind of the problem that you're solving. So
great. Happy to chat.
Lucky that I stumbled across this room.
That's what Clubhouse is about.
Huh? Yeah.
Go ahead, please.
One last thing. We actually have a super tiny grant call open right now, which will close tomorrow. But this is for e-mobility companies, which are kind of a female-led or female management team, which is a very tricky segment to find, which we knew, but we tried anyways. And it's really tiny grants. But we just wanted to see if there's something we're missing. Unfortunately, it closes tomorrow. But if anyone knows someone, feel free to send it our way. We'd be happy.
No, thanks for that. Yeah. We'll definitely get in touch, and I might have a couple of opportunities for you. So
and my LinkedIn is on the bio. Cool.
Perfect.
That was really great. Cool. Unfortunately, I have to jump out, but I'm super happy I stumbled across this room. Cool. And
thank you. And join us next week or in following weeks as well, because we have these sessions.
I'll follow you. Cool. Thank you.
Wonderful.
Bye-bye.
Thank you.
Great to meet you, Bastian.
Thanks for that. And we have others online with comments and questions. Now we have Darren from Cape Town. Darren, would you like to introduce yourself and give us your comment or question?
Hi, everybody. Thanks so much, Jim, and congrats to the two entrepreneurs that raised some capital. So in my spare time, I collect data about all the various startups that have raised capital and put it on a database. So my question is kind of related to that. I'd just like to get the two founders, what their thoughts are on entrepreneurs and founders sharing sort of deal information once they raise capital. Because obviously in Africa, there's not everybody discloses when they raise capital. I'd just like to get your thoughts in terms of pros and cons for doing that. And as far as I could tell, I think both of you have actually disclosed the fundraisers that you've finished. And have you seen any benefit to doing that, to disclosing the amount of capital raised, who your funders were, etc., and some of the concerns you had prior to kind of sharing that news information? That's my question.
Yeah, great question, and an interesting one that doesn't come up often enough. We generally, actually, I don't think we've done it yet, but we generally post on Crunchbase, round information, around history. I think we found it very helpful to publicize the recent raise. We've garnered a lot of attention from it. A lot of potential partners have come out of the woodwork and approached us that we're excited about as well. I think it's also been very helpful with our friends and partners over in the government of Rwanda. We've had recent policy announcements to promote e-mobility. I think it certainly helped that this investment has come through. It's validating, and I think that governments are keen to see that those investment dollars then flow into the local economy. And that's not to take all our money and run off somewhere else with it. And I think overall, we are a environmentally and socially driven business, and I think it's great to just get the message out there that e-mobility, in our case, that e-mobility is something for everybody. It's not just something for George Clooney and his Tesla Roadster and wealthy people in wealthy countries, but really that e-mobility is really here and for everyone, and maybe even faster and sooner in emerging economies because of the higher value, the high value proposition.
Here. I mean, I personally think the impact of electric mobility on the mobility ecosystem in Africa could be much greater than what it is in the US or Europe.
Yeah, I'll also chime in here. It's an interesting question you ask about kind of disclosing round terms. I mean, it's been overall positive for SHYFT, because our customers, and based on how our customers rely on our products essentially to manage and operate and keep energy assets up and running. They want to have confidence that the early stage company that's providing them that service that's so critical to their bottom line is growing and scaling and will be around. And so it's a great signal to our customers and prospective customers that that growth and that future exists for us, and that they can be confident in investing in SHYFT technology to support their operations, their critical operations. When people talk about the downsides, I mean, actually, let me add one more thing. For hiring, especially in markets like Nigeria, where some certain talent can be very competitive, it's great to have good signals that make people excited about joining your company. So that's been valuable for us as well. So we've been able to attract more talent as we are doing quite a bit of hiring in this current stage. Downsides, I mean, the downsides can be things like, landlords find out that, you've made a lot more money and, the rent's coming around, and it turns into a different type of negotiation, but I guess that's par for the course, so.
No, thanks for that. And thanks for the color as well. So related to that question, Darren, thank you very much, Darren, for that. Is a question from the audience. Especially given that both of your companies are capital intensive, how much of the raise was in debt and how much of it was equity? Was it all equity? Was there some portion of the debt? How does that look for both of you?
Yeah, good question. So in our case, it was all equity, but we will be raising working capital debt on the back of that equity. So
great.
Yeah, going out to the market, and probably not quite a 1-to-1 DE ratio. So we'll raise a bit less than the 3.5 million that we've just raised as equity. We'll raise a bit less than that as debt. We're still a bit tentative about it, following Series A, but yeah. So there'll be a bit of, so I guess both, but yeah.
So that means that you'll answer our phone calls when we call you from Untapped.
Sure, absolutely, always, Jim.
Great. No, thanks, Josh, for that. Ugwem, what about you?
Yep. All of our rounds raise debt, in the form of safes, however you would classify that.
Gotcha. Okay.
And but we are actually raising additional working capital on the backs of this round. So further.
Got it. And what's that ratio look like in your case? You're perhaps a little bit slightly less capital intensive than Ampersand, but nevertheless, still quite a bit of capital is needed.
Yeah, so after closing this 3.1, we'd likely be doing about another $1 million in working capital. But we have a Series A coming up likely in the next 12 to 18 months as well. So a few more points to inject capital into the organization. Gotcha.
Are you still raising? I know I missed out on it earlier, but
no, we are not.
Okay, so I missed my chance, is what you're saying.
I would, if I can just add something as well, I think it's been really interesting to see the difference in conversations we've had between say California and East Africa when it comes to investors and their priorities. I think the more sort of DCF focused investors out here are really keen to see revenue figures go up, see sales figures go up. Whereas I think when we spoke to when we speak to the Californians in general, they're a bit like, oh, you're interested in hitting EBITDA positive this year? How quaint, they're like yes, definitely, sure, increase the volume, but that's not the be all and end all. We're really now able to be much more focused on building out the tech and the systems and the automations and the processes to focus much more on the 50,000 motorcycles, the 100,000 motorcycles served by our energy network, not sort of nickel and diming over whether we're doing 750 bikes this year or 2,000 bikes this year. So that's definitely been a highlight and a really interesting difference.
I mean, look, the cultural difference between classic PE and Silicon Valley type venture capital can't be more different. The winner takes all economics of venture capital in the US just makes the incentives completely different than classic PE. So not at all surprised. And in fact, not at all surprised that some investors might say, don't even think about getting to EBITDA positive. Think about growth. Think about how you're going to capture this market first. So I think it's interesting. It's always interesting seeing the two sides against each other or alongside each other. Well, great. Well, thanks for those comments. Over to Nima. Nima, would you like to introduce yourself and make your comment or ask your question?
Hi, Beth. Thanks, Jim, for this discussion. It's super interesting and actually lends really nicely into some research that I've been doing around kind of the trends in emerging economies that relate to the tech space, especially. And one thing that I find super interesting and
I'm sorry, Nima, where are you based?
I'm based in London. I'm here in my personal capacity, but
gotcha.
I'm sure you can Google where I'm normally at. My question or comment, and I'd love some feedback on, is obviously we're seeing that there is an increasing interest in Africa and African startup ecosystems from China, India, others. And so I'd love to hear from particularly the founders on the panel, whether they have actually thought about raising capital outside of the kind of the conventional Western kind of North America, European route? Part one. And part two is, you know, if you had to say what were the kind of the top three challenges facing, you know, capital raising for African startups, what would you say? I know obviously this is more about the success stories, but I'd be curious to see where the bottlenecks are. Is it a lack of interest from the VCs in Silicon Valley? Is there, you know, a lack of understanding about the risks of investing in the African ecosystem? Limited network of local founders? Would love your thoughts on that.
Ugwem, Josh?
Yep. All right. So we brought in some capital from actually a handful of Japanese-based investors in this round, and that interest, we were seeing a lot of interest coming in from Japan in particular, but from East Asia in general, when it comes to essentially the digitalization of basically everything and anything. And that was like a key factor that was quite attractive. Also, our model and our technology being energy technology, there were a lot of Japanese companies and stakeholders that could be strategic so that we engage with. So there was some overlap there in what kind of support could be provided. As for challenges, you know, I often get asked this question about challenges for African startups fundraising. You know, I really kind of like to speak from my own stance because I just feel like there's a lot going on in different sectors. I mean, if you're a fintech founder in Nigeria, it's a very different experience than if you are infrastructure, e-mobility, energy, et cetera, in Nigeria or in West Africa. And the proxies, the market knowledge, finding the local founders, all of those things kind of come into play. I could say for myself, the challenges in fundraising really came from market knowledge and really getting to understand stakeholders and getting around maybe misconceptions about the market. And so there was some bit of like investor education, bringing them into the market, having them speak with stakeholders and customers that had to take place to kind of get around that perhaps I might not have had to do if I was in a different market.
Yeah, great insights there, Ugwem. I completely agree that each market is very different. You know, I think in our case, e-mobility being such a new space, I think such an unfamiliar technology to a lot of investors as well. You know, they'll look at a battery pack and say, I have no idea whether this is the right battery chemistry you're using, or whether this is fine, or whether you know, you need a far greater level of technical knowledge to actually get what you say you're going to do. And so having a level of technical confidence in our Series A investors, so Ecosystem Integrity Fund, they've invested in hydrogen aircraft businesses, so some pretty high tech businesses. They're very much plugged into that sector and have the knowledge base and access to the knowledge base to make those investment decisions. So that's definitely played a big role as well in generating the right degree of investor confidence. I would say that you know, speaking to the earlier question and discussion around how things have gone with COVID, we have seen most of our investors send in technical experts. You know, there aren't as many on the ground here in Africa who are familiar with e-mobility, but at least have some local market knowledge at least. So being able to bridge that gap and just you know, make sure that I'm not a Russian chatbot and come into our office and actually, okay, so yes, there is a physical human being called Josh Whale. You know, there is that too, and to speak to the customers on the front line.
Thank you both. That's super interesting. I may just kind of leave you with a parting thought, which is one of the trends that I've been seeing in the research that we've been doing is the increasing amount of not only tech hubs on the continent, and therefore an expansion of the network and potential to raise capital indigenously, but also companies and VCs, local VCs like Future Africa, that is trying to kind of disrupt the traditional capital kind of investor market on the continent by actually pooling together as a fund money from kind of middle upper class wealthy Africans to actually invest in African startups themselves. And so I think that's a really interesting trend and may hopefully reduce some of the risks associated around market knowledge and stakeholder engagement and even some of the technical expertise.
So I'd love to just add to that. Go ahead, Josh.
Oh, I was going to say, yeah, that would be fantastic. You know, we'd really love to see also just some of the wealth coming out of coming out of the sector recirculating locally and really building a local knowledge investment base. So that ecosystem factor is there's a lot of room for growth and improvement there.
Yeah, just adding to that, lots of room for improvement. I just want to echo some of the things that were in your question comments, Nima. I do think that there is an over-reliance on the usual suspects when it comes to venture financing on the continent, and over-reliance on international capital and certainly on the DFIs. And I personally believe things such as Future Africa and what they're doing and creating other sources of capital as well as other investment classes and investment vehicles to make it more feasible for local investors, whether they be wealthy Africans or even retail investors, to be involved in investing on the continent. I think that would make the ecosystem much healthier than it is today with the over-reliance on DFIs and international capital.
If I
Great,
can,
well, thanks. Go ahead, Darren.
If I can just add, just in terms of what we've seen happen in Egypt as well, kind of echoes what's been going on with Future Africa, that there's quite a strong angel network presence in Egypt, and over the last few years, the amount of capital going into startups in Egypt has accelerated. So yeah, I think that's a good sign to see sort of a wider range of different types of investors starting to invest in early stages.
Yes, no, and I think part of that's going to come into somewhat of an innovation around the types of vehicles available for investing. A 2%, 20% venture model isn't going to be the appropriate model for all investors. And so I think there needs to be some innovation and testing around different investment vehicles for allowing other kinds of investors to invest. Great. Well, thank you for those comments. Want to move on to Jeffrey. Love the intro and comment or question from you.
Hello, guys. I love what Josh is doing, and thank you so much, Jim, for bringing such amazing people to the platform. I run a startup in Uganda called ChargeCo Technologies. What we do is we are making owning and operating battery-powered devices more affordable and convenient. And why we say battery-powered devices is that we're not only thinking of mobile phones, which is what we're doing. We're setting up charging stations for mobile phones in public places, but we're also looking at things like power storage or ESS systems, and electric vehicles. That includes cars and motorbikes. So I have a few questions for Josh, and I am really interested in electric mobility. One of the things that I'm seeing is, of course, battery charging. I mean, battery swapping is the trend with most of the e-mobility players in East Africa and even in India. But then, is there an opportunity for battery fast charging? So if you look at how mobile phones evolved, we had phones with removable batteries, where we would swap out one battery when it's done instead of charging it, and then you'd have an extra battery. But now with fast charging, with Quick Charge 5, you can basically charge your phone to about 50% in 5 minutes. Do you see that trend coming in terms of in terms of e-mobility, and particularly for the smaller vehicles with small battery packs, 2 to 3 kilowatts. And then on the side of growth, do you what would you choose? Building and manufacturing locally, or designing and manufacturing abroad? So are you taking an OEM type of direction, or an ODM type of direction? Because I've tried, for example, doing the the charging stations for mobile phones locally, and trust me, it's not worth it, because you're getting all the components from outside the continent. You don't have enough skilled labor to help with manufacturing. You don't have very good partners you can outsource to. And at the end of the day, you find yourself producing an even more inferior product compared to, outsourcing it to a Chinese or German or a foreign contract manufacturer who is very well equipped with knowledge and has done this for a while, and they have all their ducks in a row. And yeah, so that's basically some of the questions. I had way more because I'm an EV enthusiast and I'm looking to play in this field, not only from a charging perspective, but also from a battery manufacturing perspective. However, I would love to hear your thoughts on that.
Okay, Jim, how long have I got?
Go ahead. If you can answer the question in perhaps 60 seconds, that'd be great.
I'll try. Okay, so fast charging versus swaps, really interesting question. I think in our sector, we'll see fast charging come in eventually, but we think it'll be about another 4 or 5 years until it's cost and performance competitive with the using a swap system. I think we were looking more towards solid state lithium batteries. I completely agree. I really liked my old Nokia phone where I had like 3 different batteries that I could just change out. I actually charge my iPhone about 3 times a day. So I think the current system is inferior. Maybe I've got an older iPhone, but I would love to be able to swap out the batteries in my phone. So I'll just put that out there. I think it's going to be very different for different sectors. So like for a phone, the relative cost of the battery compared to the value of the phone, it's probably about what, $30 out of maybe let's say a $500 smartphone or a $300 smartphone. And so having a fancier battery, just the marginal cost difference isn't the same. With an electric vehicle, the battery is probably half the cost of the product. So those marginal differences in cost just make a much bigger difference. If your battery costs twice as much, that's earth-shattering. And then on growth, there's just no simple answer for that. We do build our battery packs here on the ground in Kigali. It makes sense for us to do that, and it makes sense for us at this stage of growth. EVs are just so rapidly evolving that the math it's a lot of crystal ball gazing. For example, laser welding of cells, you would have to spend $3 million to do a production line for that. Now you can buy an off-the-shelf machine for $200,000 and weld your battery cells into modules. And that just changes every 8 months or so. There's going to be, I think now the level of supply also on the battery side is the level of demand is more than caught up to the level of supply. So that's also going to be a factor in supply chain planning. But I think it's just something you're going to have to keep on top of and keep running the numbers on and evolving and planning to evolve and be nimble.
Thanks for that, Josh. And we have one more person on the list, and then we'll just do it. Perhaps Rishi, if you can do a quick comment or question, and then we'll go to final words from Ugwem and Josh. Seems like we have some connection issues on your side, Rishi. Can you hear us? All right. So we're having some connection issues. We barely can hear you, Rishi. So why don't we go to last words from Ugwem and Josh? Any final words of advice to entrepreneurs out there who are raising in the last legs of this pandemic?
Sure. I think one of the common themes that I've seen in the discussion today, and I'm glad that I was joined by Josh on this call, is really about, when you've identified your vision and what your company is really trying to achieve, the mission. And I think what's unique about the call today is it's really about like leapfrogging and kind of actually being ahead of global markets when it comes to innovation in e-mobility and decentralized or distributed power systems. The best thing that I was able to do, and the advice I give to other founders and entrepreneurs, is really just early on try to find investors who, when you ask them what does the future of named sector look like, that it really does align with your vision and your mission, and basically working backwards from there. That's been helpful in finding who's a right investor, who's a good fit, and helping me actually move on from conversations and not wasting too much time quite early on. And it also means that when you actually bring them on board, that we're really working towards the same thing and there's not, conflict thereafter. And so that's been key in the pandemic, because there's a lot of uncertainty that people are experiencing or feeling. And so if we can be a bit more confident and certain in what the future of our respective sectors or industries look like, and what our roles, what your role as a company or my role as a company looks like in that sector, it's really been critical to making fundraising a much smoother process.
Thanks for that, Ugwem. Josh, last words.
Ooh, thanks, Ugwem. That was great. I've just written that one down for myself too. It's really good advice. I think for us, I guess if our experience is anything to go by, then just never give up. I think we've really sort of disproven the idea of fail fast. I think when you're trying something hard, stick at it. I founded this company in 2014, and I didn't get a salary until I think 2017. Could have gone a bit faster overall. I think not to say that that's just the way it had to be, but just be really resilient. I think there is take heart. There is a lot of I'm hearing there's a lot of dry powder. There is a lot of investment funding out there. If you can persuade an investor to travel or get through the the COVID restrictions and use virtual tours and so on, then do that. Do what you can. Be creative about it. But there's definitely light at the end of the tunnel for sure. There are VCs out there that have millions of dollars to deploy, and they've only got so many years to deploy it. And they are hungry. So get out there. Get out there and go for it.
Got it. So find investors that are mission aligned and don't give up. Thank you both for all your incredible feedback, and congratulations again for closing your rounds. And thanks to the audience for joining us and your contributions with questions and comments and experiences. I hope to see you next week. We'll have another session, same time, same place, 9 a.m. Pacific time, 7 p.m. East Africa time on Clubhouse, with another topic about entrepreneurship and investing. To follow us, find us on Twitter and LinkedIn at